Hello and welcome back to the FX Evolution trading course. Today we'll be discussing the topic of tops and bottoms within the Forex and other trading markets. We'll also be looking at how we as technical analysts can correctly identify stop loss levels and take profit levels for each one of these particular patterns. Let's begin by defining what a double top is. So a double top is made up of two approximately equal peaks in an upward trending market. It's also a common reversal pattern. So this means that when we correctly identify a double top, it could mean the end of the previous uptrend and signify a downtrend. The pattern is also completed when price moves below the neckline. So let's take a look at what that means. Here we have an upward trending market. You can see that we've reached a high and then been unable to make a new higher price. So prices then come down and then try it again to reach a new high. At this point, price has been unable to break to a new top or high, and price is coming steadily down. At around here, we're going to be able to draw this and say we had a top here and a top here. And so 1 and 2, and this is what forms a double top. We can also now draw the neckline area, which is the previous low in between the two tops. So how do we trade this strategy? Here we already know the neckline and we also know our tops. When price breaks below the neckline, we can look to sell the market either as a market order or a pending order, which we can place if we're not going to be there at the charts when this could break through. We also know, because it's a pattern, the stop loss area, which should be placed above the two previous highs or tops, and we can identify the take profit area, which is the difference between the neckline or low and the previous two tops. So that will mean that our profit will be that distance down here. So as a quick rule, A equals B, or the distance between the double tops and the bottom will equal the profit target that we should be looking for this particular trade. Let's now take a look at double bottoms. So double bottoms are made up of two approximately equal troughs this time in a downtrend. Like in the double tops, it's also a common reversal pattern. So we'll generally be looking for a potential breakout to an uptrend after the neckline has been broken. So here we have an example of double bottom formation. A steadily decreasing market, forming a low, coming back up, and then as it comes back down to test that low, it's unable to break to a new low. It then comes back up, and we can draw here the neckline area, and we also know that there's been a bottom here and a second bottom here, or two bottoms. This forms the double bottom, and therefore when price breaks again above the neckline, we'd be looking this time though to buy, with our stop below the two bottoms and our take profit as the distance between the two bottoms and the neckline. So let's now take a look at triple tops and how to define those. Triple tops are made up of three approximately equal peaks in an uptrend. They can also be a reversal pattern, just like double tops, and the pattern is completed when the price moves below the neckline. So here we have an example of an upward trending market. We've got a high followed by a low, followed by another high where it's unable to break past the previous high. This would be our double top. This time, however, it's come back down and tested our neckline area and then been unable again to break to a new low and come back up and tested our high. At this point, we can see price still has not been able to make a new high, and this forms our triple top or three tops. Triple tops are generally stronger than double tops because there's more memory in the market or more history for people to see. More traders are going to recognize this pattern when it forms a triple top, and therefore the psychology of trading this could mean that it's a higher probability to work out. To trade the strategy, we use the same method. We place our sell, whether it be market order or pending order, below the break of the neckline, our stop loss above the previous tops, and we take the distance between the neckline and the tops, which then forms our take profit area. So again, A equals B in this case. So let's now take a look at triple bottoms. So they are made up of 3 approximately equal troughs in a downtrend. They can also be a reversal pattern, and again, just like the triple tops, we're looking at probably a stronger pattern here because it's happened 3 times. And the pattern is completed when the price moves above the neckline. So here we have the steadily decreasing market. It's made a new low or bottom. It's come back up and tested, and then it's made a second bottom and a third bottom. This is when we've got the 1, 2, 3 or triple, and when price breaks above the neckline, we can now look to buy this particular market with either a market order or a pending order, with a stop loss below the previous bottoms, and a take profit at the zone A, which is between the bottoms and the neckline. So let's now take a look at a real-world example of double tops. Here we have the Euro-Pound weekly chart taken from the MetaTrader platform. I think it's important to note that it doesn't matter what time frame we're looking at, because pattern recognition techniques can be used on all time frames. Whether you're trading a 1 minute, 5 minute, 1 hour, daily, or even monthly, they will work on all time frames. And that means it's great for us as traders to understand this, because whether you want to be a scalper or an intraday trader or a monthly trader or even a yearly longer term trader, you can use this method across all of those times. So here we have an upward trending market. It's reached a high, it's been unable to go any higher, and it's come back down. It's then gone back to test that high and again rejected that zone and coming back down. At around this point, or halfway to the neckline, we'll be able to draw the neckline and say, okay, this is now looking like a double top. Because we know how to place stops, when the market makes a new low and breaks that neckline right here, we can enter the market with a take profit here, because that's the distance between the highs and the lows, and put a stop above the previous peaks. You can also note in this example that this was actually the end of the uptrend. So we had an uptrend coming into the double top, and then as the double top broke down through the neckline, it actually instigated the reversal pattern, and we now have been in a downtrend ever since. Here we have an example of a double bottom within the market. Price has been steadily decreasing. It's formed a low, been unable to go any lower. It's come back up, tested that low again, and again been unable to break it. At this point here, we can draw our neckline, and when price breaks to a new high, we know our target zone, we know our stop zone, and it would have been a very successful trade. Again, the reversal has happened. So you can see how powerful this can be as a pattern recognition technique. Here we have a triple top example. Price has come up, it's reached a high, it's come down and tested a low, it's come back up, tested the same peak and formed a double top at this point, but it's been unable to break to a new low. I think this is a good example as well that we need to wait for clarification of the break. So here it was unable to make a new low, and therefore we should not have been trading this and should not have jumped the gun, I guess you could call in trading, and entered early. Price has then gone back up, reached the same highs, and been unable to break to a new high. So at this point here, about halfway down, we can draw this as our triple top, we can draw our neckline, and as the candle breaks through here and forms a new lower price, we'll be able to enter the market with a sell order, with a stop above the previous highs and a target zone from the distance between the lows and the highs. And again, it was a successful trade. Here we have an example of the triple bottom. Price has been steadily decreasing. It's formed a low. It's come back up, tested a high. It's formed another low. It's then formed another low. and it's been unable to break any of the lows or bottoms. And as it comes back up to our neckline, you can see the price has broken through, and we have our target zone, which is the distance between the neckline and the lows, and it would have been another successful trade. We can also see how the target zone here has formed some form of resistance. So we know as technical traders it was a very good target zone because many people were taking profit at this zone. It took quite a while for it to actually break through and actually created another pattern within here. We can also see it was a reversal of the previous downtrend to the uptrend. If you'd like to find out more advanced trading techniques on tops or bottoms or other pattern recognition techniques, I encourage everyone after they've finished this course and after they've traded for a little while in a demo and live account to take a look at our advanced strategies course. That's it for today, and we'll see you in the next video.